you gonna give a heads up on the strategic planning and the interviews? Thank you.
Now that you already gave the heads up.
Just these folks.
Giving you guidance.
Yeah, we're going to Houston at the end of September. It's more of a social visit.
A better time to make
Yeah.
school.
We think, although it's in the middle of
Sure.
season.
So, yeah, my daughter's, well, not her, she was on there. And they said the two different pieces in the middle of September, so. No, I got one, not just a few days.
When?
Monday.
Oh, really?
No,
Okay.
I think to get them to the so. So, I signed up to go. At bachelor's first.
Really? So I thought they were pretty good.
Say something good because they're
Very
very
unusual.
Was it last time that my phone went screaming off? in the middle of the
Yes.
meeting? It was like, hey, what's happening? And it was like, whoa, Debbie, what kind of music is that?
That was funny though.
I know, I was like, what the hell? It was just, I was kind of trying to stay awake. No, I'm just kidding. But really, I get it. But they're cracking me up.
Robert, who's your audit firm?
Gibson, Ruddock, Patterson.
Okay.
Oh, yeah.
Yeah, that would be for them.
Yeah.
They're unique in that.
That's their public entities is their forte.
I saw you one day.
We've got one.
You were over there. What'd you think? You were there on the second day?
Yeah, what was that second
I thought the second day was so much better.
We're in the,
located.
yeah.
You
I thought the
know,
location was better
No,
for sure.
not the first day. I mean, I sat up close. I mean, I
Two
see,
cabins.
but it was like,
It's not the right
you know?
environment for that. Let's rock and roll.
Ready, Dick? Yep.
Good morning, everyone. This is a regular board meeting of the City of El Paso Employees Retirement Trust. Today is Wednesday, August 20th, 2025. The time is 8:33 a.m. and we do have a quorum. Would everyone please silence your electronic devices so as to not to disturb the meeting? Thank you, and please stand for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. You may be seated. Notice to the public, all matters listed on the consent agenda will be considered by the Retirement Trust Board to be routine and will be enacted in one motion in the form listed on the agenda. There will be no separate discussion of these items unless members of the Retirement Trust Board or persons in the audience request specific items be removed from the consent agenda to the regular agenda. For discussion prior to the time the Retirement Trust Board votes on the motion to adopt the consent agenda.
Motion to approve.
Second.
Okay, we have a motion made by Matt, seconded by Ms. Hamlin. It does require polling. Ms. Blascala. Mr. Kerr.
Aye.
Ms. Hamlin.
Aye.
And Mr. Peña.
Aye.
And Mr. Studer.
Aye.
Motion passes. Going on to the regular agenda, under item 7, discussion and action regarding the Treasury report for the month ended July 31st, 2025. Louis Meyer from the City of El Paso Comptroller's Office will be presenting.
Morning,
Good
Louis.
morning, everyone.
On the statements of net assets available for benefits, the statements contain the assets, liabilities, and net assets available for benefits at July 31st. Statement is a valuation of assets and liabilities at a specific point in time. Each line represents actual amounts except for investments. Investments is an estimate of what the portfolio was worth at July 31st. Beginning at the top, total cash and investments, approximately $1,031 million. That's up $5 million from the prior month or last month. Below that, receivables are amounts owed by others to the retirement trust. May consist of pending proceeds, contributions, interest and dividends. That totaled approximately $3.2 million. Liabilities in the lower portion, amounts owed by the retirement trust to others, consisting of accrued expenses. These are expenses that have been incurred but not yet paid, and those totaled approximately $473,000. Combining total assets and total liabilities, we arrive at net assets available for benefits of approximately $1,036 million, and that amount is up approximately $7 million from the prior month. The statement of changes in net assets available for benefits, these statements represent the flows that occurred during the fiscal year. The left-hand column is for the 11 months ended July 31st. At the top, we have total receipts. Those were approximately $58 million. And that continues to average approximately $5.2 million per month. Net investment income was approximately $69 million, up $8 million from the prior month. Total additions, that would be combining the total receipts and the total net investment income, approximately $127 million. Deductions below that, benefits paid to retirees totaled approximately $76 million, and that continues to average approximately $6.9 million per month. Refunds for the 11 months, approximately $4 million. Total deductions, approximately $82 million. The net increase for the 11 months, approximately $45 million. Combined with the beginning net assets available for benefits, we again arrive at ending net assets available for benefits of approximately $1,036 million. Quarterly statements of changes in net assets available for benefits. The left-hand column is for the 2 months ended July 31st. Contributions for the 2 months, approximately $11 million. Net investment income, approximately $33 million. Combined for a total net addition of approximately $44 million. Benefits paid to retirees in those 2 months totaled approximately $14 million. And the total net increase for the 2 months, approximately $29 million. Again, combined with the beginning net assets available for benefits for the quarter, and we arrive at net assets available for benefits of approximately $1,036 million. Investment income analysis page provides a breakdown of the investment performance, distinguishing between different sources of investment income. The analysis also provides actual and targeted returns. The top left portion highlighting 2, the realized gains for the 11 months, approximately $89.5 million, while unrealized losses were approximately $25.9 million. In the lower portion, we have the return for the 11 months. That is 7.01%. And the calculation takes the net investment income as the numerator and an average of the net assets available for benefits as the denominator. The trust has as its annual target for the fiscal year 7.25%. 11/12 of that is 6.65%. The first chart is a time series expressed in dollars, expressed in millions. We have fiscal year 2023 on the left through fiscal year 2025. Orange bars representing the cumulative target return or cumulative target income, and the blue bars representing the cumulative actual income. This graph expresses it in percentages, and so again, same fiscal years, 2023 on the left through 2025 on the right. Orange bars representing the cumulative targeted return, while the blue bars represent the actual return, cumulative actual return. Refunds and administrative expenses expressed in millions. Fiscal year 2018 on the left through 2025 on the right. Benefits paid to retirees, again expressed in millions. 2018 on the left through 2025 on the right. For 2022, the yellow portion represents the 13th payment, and the amount is disclosed at the bottom. Also disclosed at the bottom is an estimate of where this fiscal year is expected to total in terms of the benefits paid. A graph of the net assets available for benefits by month in millions. A graph of the retiree composition, divided by age bucket, and then further subdivided by gender. And finally, the benefits paid to retirees for the fiscal year. In this graph, those amounts are grouped by age bucket.
Comments, questions from the board? Mr. Ash, Adrian, any thoughts?
So we got 1 month to go,
Yeah. good
and so we're
numbers
sweating it
far.
out. Actually have 10 days left to go in the market. Market's acting a little toppy. I'm sure we'll hear from our investment consultants, but equities are up for the month so far, so it looks like we've got a pretty good shot of hitting the 7.25%. As long as things just don't crater. Some big events happening with the Fed this week, and so we'll see what happens by Friday. The minutes of the last Fed meeting come out this afternoon at 2, I guess 12 our time, and then the Fed chairman will speak on Friday, and they may move the markets a little bit, so we'll sweat out this next 10 days, see what happens.
Thank you, Louis.
Thank you.
Going on to item 8, discussion and action regarding the receipt of the investment performance reports from month ended July 31st, 2025, and for the quarter ended June 30th, 2025, and related matters from Kellum LLC. Alex Browning will be reporting.
Morning, everyone.
Good morning, Alex.
Thank you. I have a new pair of goggles on, so I'm going to see how this all works out. Oh, thank you. Does this one work too?
Not for this.
Okay, all right, got it. So what we'll look at is the July flash report, preliminary estimates of the performance. We've been pretty well rewarded for taking risk and risky assets. Private equity hasn't yet been written up, and it's just sort of a factor what's happening in the private equity market. There's just not a lot of transactions. Lending rates or private credit by which they finance purchases, it's been a little bit elevated. And so there's been this huge bid-ask spread between what people are willing to sell at and what people want to buy at. And so we haven't really seen a write-up in private equity assets quite yet. I think to echo Robert's last comment, it's going to be pretty tight to get to that 7.25. I mean, you know, it's really a 50-50 at this point, not much below or not much above for the fiscal year end. So we have to just see what markets do. August 31st tends to be sort of a weird date to end on in markets because folks are, you know, on the East Coast and Wall Street or in Martha's Vineyard and Cape Cod and stuff. So there isn't a whole lot of transaction activity that can work in your favor. Sometimes it doesn't.
I would ask, since you bring up private equity, just the recent rule changes that are going to allow private equity in 401ks. I would ask that our finance committee discuss that with our managers when they come in, if they're going to offer any products and how they see that impacting deal making in the private equity space, just so we have an understanding of how it might impact our investments.
Absolutely. And Portfolio Advisors actually has, you know, some evergreen funds that they're offering out there. I'm not sure about Adams Street at this point, but it's one of the avenues where the fees aren't as compressed relative to institutional investors, where you just have much more bargaining power. But the additional demand should really help because, you know, it's just kind of fewer deals being chased after by more dollars. You know, regulations will probably change over time as, you know, liquidity features, you know, will probably tend to fail in that retail market. So with that said, just to look at the July flash, the percentage difference column that I'm highlighting here with the mouse shows you that you know, currently you're overweight to private equity. Again, this is just a factor of you can't get in and out very quickly, so when it tends to rise above its target, you just have to ride that out. That's being largely funded by domestic fixed income. Generally, we are taking money from domestic equities because it's more of a risk, you know, a matching risk with private equity. And we've been doing that, and we've been, you know, putting more money in fixed income, but equities have just been outperforming. So, you know, whenever we have rebalancing transactions, we're trying to bring up the domestic fixed income to its target weight of 21% and hoping that as we see more realizations in private equity, that it kind of floats down a little bit in value. Moving on to the next page, we can see the asset distribution, or just, you know, what I would call the balance sheet. And this is for 1 month period. Again, these are preliminary estimates. We're using index proxies for private equity and real estate. So there is some variation between what'll be actualized. What you can see at the very bottom, I think this tells the story. You started at 1.3 billion. You had investment returns of nearly 11 million. Distributions of, you know, about 2.6 million for benefits and expenses, and so ending the month up about 8 million on a net basis, which is a pretty good month. In terms of returns on the last month, domestic equity up 2.1%. We can see that there's a difference, especially if you go from last month to fiscal year to date, between large cap. So we can see, you know, 225 for the month versus a 191 for the SMID managers, 174. But if you go out that fiscal year to date, you can really just see how dominant large cap, the largest companies in the US, have been relative to the smaller and medium-sized companies. And so on a composite weighted basis, underperforming the Russell 3000 a bit, and that's just the result of having this big tailwind of AI investment and smaller and medium-sized businesses suffering a little bit from higher financing costs and more concentrated client bases. International equity has been a real bright spot. We can see that you know, the return to the composite at 13.3%, relative to the benchmark at 11.65%. I think everyone who's sitting in front of me right now can remember certainly questioning, why are we invested in international equities? Well, now we're starting to see it because it's outperforming the US. A large part of that is the declining dollar. So that's been a big tailwind for domestic U.S. investors in international equities. And it just reinforces the fact that it is diversification. The U.S. is not the only market out there. The vast majority of the population of consumers in the world are outside the United States. So there are benefits to having that diversification in the growth asset. And if you think about it just from a volatility standpoint, it's smoothing the cycles of under and over performance. So private equity, we don't have a monthly return. We will be showing, just thinking, so in the quarterly report, we do show the actual returns, but for right now, we're proxying to the public markets. And you can see, you know, for the fiscal year to date, private equity not really outperforming public equities for reasons earlier mentioned. But if you go out, you know, this 5-year number, you can see a substantial amount of outperformance. And as you go further out, it does hold. Fixed income, the composite's outperforming its benchmark, you know, by a handful of basis points here and there. Over the longer term, about 40 basis points. You can see that overall absolute returns are not, you know, getting people to jump out of bed, but they are providing that anchor to windward that you need for more volatile assets and equities and real estate. And so overall, you know, the managers are doing well and, you know, providing that source of return. Real estate, actually, you know, we're starting to kind of see on a relative basis, at least, a bit more in line with the benchmark. And we can see that there's been outperformance out to 3 years. Transaction volumes are starting to rise in the commercial real estate market, so multifamily, industrial, retail, office even, seeing some, you know, I guess green shoots, so to speak. There was a headline in the newspaper you might have seen, I think it was JP Morgan just recently started moving into a new building that they purchased and built from the ground up for $3 billion. So it looks like, you know, at least in some of the major cities, that folks are starting to move back to the office market. And UBS showing some positive excess returns, but still kind of struggling against the benchmark. Currently, we're in the redemption queue, and you'll recall that we had hired another core open-end real estate manager, TA Realty. They're not showing up in this performance table because the funding didn't happen until the beginning of the quarter. I think it was April 1st. So we will see that performance show up as a separate line, but it is included in the real estate composite performance figures. So at the total fund level, a bit above benchmark. Again, we're proxying real estate and private equity to indices, but you can see right here the fiscal year to date on a gross basis, 7.71%. If we, you know, assumed a 0% return to private equity, you know, you're probably closer to 7 to 7.25. So that's where, you know, the earlier comment came, is that this is going to be a really tight race to that 7.25 for this year. But over time, you know, if you go out, you can see that you're outperforming that 7.25. So that means that not only are you funding your benefits, but you're also, you know, also gaining some funding advantage when you hold liabilities steady. Of course, liabilities have grown a little bit larger as a result of some mechanical issues. So I'll stop there, see if there are any questions about the monthly report. You know, normally the quarterly report is a little bit more informative just because you're using actual figures.
Questions from the board? Mr. Ash? Okay.
Okay.
Thank you.
Mr. Chair, if you'd like, I can go through the macroeconomic update.
Please.
Okay. There we go. All right. So, interestingly enough, you know, I guess, you know, read the headlines, you can get different impressions from time to time, but on a macro basis, unemployment's still really low at 4.1%. We saw, you know, I guess some initial claims, you know, rise a little bit, but not much. You know, I generally think of unemployment above 5% being where you start to worry, because 5% is historically, you know, what we call frictional unemployment, where people are quitting their jobs and looking for new ones. That's not a problem. If you quit your job, you're pretty confident you're going to get another one. In terms of inflation, inflation's been pretty moderate. I mean, you know, the Fed has that PCE target of 2%. I think that's a bit artificial, maybe even aspirational. But, you know, I guess, you know, sort of on a consumer basis, 2.7 to 2.5%, it's not really ruining the budget. It was the fact that we had 9%. And so prices don't fall. They kind of always keep rising. But the new base is pretty well stabilized. But that will, in fact, you know, inform what happens with the Fed at the next meeting in September. And the market largely expects a cut. Now, how many cuts? And generally when I say cut, 25 basis points, 0.25%. I don't know what the latest probability figures are, but I believe that there's a prediction by the markets that it's going to be like 50 basis points. I tend to be total for September. I tend to disagree. I think it's a 25 basis point cut, just given the fact that inflation is fairly stable and unemployment isn't rising. But, you know, they're very data dependent. You know, and then on the another positive note, real GDP came in at 3%. 3%, you know, doesn't sound like a lot, but at an economy-wide basis, that's a really healthy growth figure, especially coming off of a slightly negative one for the first quarter, and that was the result of folks trying to get ahead of the tariffs for, you know, supply chain. Sorry. So we can just see broadly, unemployment rate is pretty low historically. I mean, actually, it's really low historically. You'd have to go back to, you know, World War II to really get below that. Job openings are starting, you know, just kind of, they've fallen off from that COVID recovery, but they're pretty much following in line with the trend. And job losses, you can just start to see a little bit of a tick up here in that blue line. But, you know, nothing material, probably more noise than anything else. And let's see. So stock market volatility, it's been elevated. This is the Chicago Board of Exchange Volatility Index. It's a measure of you know, forward-looking expected volatility, and it spiked right after Liberation Day, or when the initial tariffs were announced, to 45, and now it's back down to like 15.5. So really more of a normal-looking market right now. And so to round that out, you know, just looking at returns to different asset classes, U.S. equity, I have a highlighted column for the 1 year, 15.3%. You know, on a sort of think about doubling your money, that's probably, you know, 4 years to 4.5 years to doubling your money. MSCI World ex-USA, again, sort of, you know, we sort of put into our minds that outside the United States wasn't a worthwhile investment, and now we're starting to see the gains of just being a little bit more patient and realizing that they're going to move out of sync with U.S. markets. Fixed income, a very healthy return at 6.08%. That's a result of interest rates falling in the middle part of the curve. So as interest rates fall, you get a boost to your price, and then you also pick up the coupon. Our long-term forecast for fixed income is probably closer to 4.5%. So, you know, again, even in stable assets like fixed income, you're going to see volatility in the returns, just depending on what's happening with the Fed and the expectations of the market. Okay, so the next, sorry. In real estate, we're starting to, we'll look at this in a little bit, but real estate is starting to show a little bit more resilience. And then just, you know, kind of interestingly, if you think about what the market psychology is around returns of 15.3%, that's pretty bullish. You know, people are pretty optimistic. Yet the spot price on gold is up 41.38%. So which is it? Are we pessimistic or are we optimistic? This is, you know, sort of where we find ourselves, and that's also a driver of volatility. And then just, you know, because we're where we are, West Texas Intermediate crude is probably at about $62 a barrel. It hasn't been that low since 2021. So that's, you know, one of those signs, well, okay, too much supply or is a lack of demand? It seems like demand is there, so it's the, the supply coming from OPEC a bit. I did notice when I was in Montana just about a week ago that 91 octane was at $3.15. I haven't seen it that low anywhere. So that's good news for the consumer. Private equity trends. What we're showing here are the returns in green to private equity. It's the median return for the broad private equity universe. And then next to that, what we call a public market equivalent. So if you took the cash flows that you invested in private equity and put them in the public stock market, what would the returns be? And you can see that the public stock market has outperformed private equity over the last 5 years. And it's really until you get through 7 and 10 and 20 years where you start to see that sustainable expectation of 2% above the public market index. But reinforces the fact that cycles of public equity outperformance can last much longer than most people think. If you look at that 20-year and 10-year figure, that is inclusive of all of the years leading up to that. So it's not just, being, it is not ignoring the underperformance in recent years. And then real estate, just to round that out, we can see that over the last quarter, about 1%, that's coming from income, appreciation 0. Over the last year, 2.7%. And if you go across this income line, you can see that it's really clipping off about a 3% income yield, so just a little bit higher than what you're seeing over those periods for fixed income, because we did go through that period of zero interest rate policy where coupons were pretty close to zero, even for credit. And then, hotels struggling a little bit in terms of capital appreciation right here. Office, we're not seeing many write-downs in office now. Office is pretty close to cost, but you can see that the income figures are all positive and healthy.
Is the market still pretty frozen?
It's starting, actually it's starting to unfreeze. I think the question is how much of an impact will a rate cut contribute? I mean, if we see a 50 basis point rate cut, I would expect that private equity returns and private real estate returns should benefit pretty greatly. Because then, that bid-ask spread kind of narrows because the cost of financing the purchase comes down. And so that was it for the economic overview. Are there any questions, topics for discussion?
I've got a weird question. In private equity, where are we, not we, but the world, in the cycle of private equity? Is it still in its infancy stage? Is it in its teenage stage? Is it in its adult stage? Where would you, like I said, off in left field?
It's
I'm just hearing so much more
Sure.
about private equity today.
I mean, it's not in its infancy, for sure. You think back, and private equity sort of became a thing in the late 70s.
But it had a very slow start.
It did. And that was just because public markets were dominant. Private equity continues to, sort of grow in popularity, especially as, regulations changed. I mean, there were points in time where pensions weren't allowed to invest in private equity or private assets at all. To answer your question, though, I would say that, we're probably somewhere between 16 and 25 years old for the private equity folks. I think that the next stage of investment through the retail market will bring about sort of an increase in age. Because, outside of the retail market, right, there's not another source of large demand change. And so at that point in time, you'd expect that it's kind of more mature.
Yeah, pensions have already moved. Institutional investors have so that if they want to expand the market, and you're seeing fewer companies go public, there's just fewer public companies available at all cap levels, and so private markets are where investors are trying to get to.
Yeah, and very similar situation with private credit, where Dodd-Frank can strain the ability of banks to lend And so into that void of capital, private funds had to be the lenders of, next resort. So,
Any other questions, comments from the board?
I would just say, just real quick, my concern with private equity is that, from a industry level standpoint, I think all the low hanging and even mid-level hanging fruit has been harvested. And, that's why I'm getting, and I'm sure you are too, Renee, daily emails and calls from equity firms all over the country trying to invest in my accounting firm, which I find very weird. And now with the ability of retail investors through 401k plans being able to go into private equity, while I think that is good for current portfolios, it does give me pause for the future investments in private equity. And as you put it earlier, a lot of money chasing ever fewer deals and ever fewer attractive deals. And so I do think that is something, that environment that I think we're about to get into is something that we need to be aware of and something we need to think about.
Yeah, I think the investment committee has some work on its hands to make sure we're doing our due diligence as the private equity firms come in. Yeah, I mean, 401ks, is that exit liquidity for institutional investors like us? There's a lot of talk about why that is being allowed suddenly.
Yeah, no, I mean, and the market for private equity is changing quite a bit. It used to be that you could just go in, financially engineer the firm, increase debt at a very low cost and see a big return. And now the onus is really on the operators to make operational improvements, whether it be, to buy a firm like yours, Matt, and then put it on a platform with multiple different accounting firms and a common technology system to reap the benefits of cost reduction.
And it's taken some bad PR hits as
For sure.
many firms that are going out of business. It comes out later, oh, it's private equity, did something short-sighted to boost profits. And so that's what's causing bankruptcies amongst favored businesses out there. Mr. Ash, you have comments?
No, I think we have to take a longer look at private equity. Private equity has certainly been mucked up for the last maybe 3 years at this point. It's starting to thaw out a little bit. We can see more capital calls, but more distributions, which means there's probably more LPs that are being able to get released and sold, but it's not substantial like it was maybe 4 or 5 years ago. Longer term, obviously the private equity returns are better than domestic equity or international equity. The risk is higher, but certainly I think it's caused us as a portfolio to kind of not look as good as we have in the past. And so I've requested that Callan go back and look at maybe some benchmarking issues. And if you look at our peer returns, they have not improved over the last 3 or 5 years. So we've asked the investment committee to kind of go back and look at that, and Callan's going to work with us. And I think Callan can identify why their peer rankings are down. The big question is, what do we do about it? And so I expect the investment committee will be looking at that in the near future.
Okay.
All right. And then if you just bring up the slide deck, just one more. I just wanted to give you a kind of recent activity. So we've been busy. First item up there, international equity search. We terminated Lazard about 6 months ago, and then the investment committee got together to look at different alternatives for public equities in international markets, but that would give you similar economic exposure to the extent that we could. So we're continuing to work on that. TA Realty was a new contribution April 1st. We've reviewed AllianceBernstein, who's a small and mid-cap U.S. equity manager. They've been struggling against their benchmark and are running into compliance issues with the IPS to show outperformance net of fees over a 3 and 5 year basis. And then finally, the asset allocation item related to the international equity, what can we look at? In terms of manager and organizational team changes, none of these are notable. just really movements at the top and retirements. And then maybe just for the last item here, outstanding and proposed items. Generally, each year we do a board education session in late October, right around Halloween. We can discuss that at the IC meeting and then, come with a recommendation as to topics that might be of interest or helpful. And then finally, we'll be doing a private equity commitment pacing analysis, which looks at the expected distributions from the portfolio right now. You're overweight by about 3%. And also maintaining vintage year diversification, because vintage year really is a large determiner of how well you do. At what price did you buy, and then where do you have to sell? And so looking at that and then figuring that out on a total plan basis, what kind of cash flows you need to service those capital distribution or capital calls, such that you're not, you're doing it at a measured pace as opposed to right now is the great time, but oh wait, we don't have cash. So just a planning feature for private markets in general. And so with that, I can conclude my remarks, or we can look at the quarterly, the last quarter's results. I mean, you saw July. The story there is, fingers crossed, we're going to hit that 725 at fiscal year end at the end of August.
Mr. Ash?
Mr. Brownlee, if you go over page 14, and please note that AllianceBernstein was put on watch at the last investment committee meeting, so the
Is
board
this-
has taken action.
Is this 14?
Hold on.
Wait, excuse me.
Yeah, it's
Oh,
the
okay.
compliance.
Sorry.
page.
Let me,
Okay, thank you.
Mhm.
So, as trustees, you have the overarching responsibility to make sure that governance and compliance with your policies, are followed. And number one, are the assets invested as outlined in the IPS? And right now, you do have a compliance violation, so to speak, where the actual weight of private equity is outside of its top bound, which is 16%. And as a result, fixed income is below its lower end at 21. Again, we are rebalancing as cash flows coming in and out. And so, those cash flows in, go to fixed income, but when U.S. equity markets outperform, the relative weight, kind of drifts down. So we're always kind of fighting the tide against that. That has worked in your favor, but staff is basically managing the cash flows to maintain that. The weight to private equity is just relative to what's happening in your other asset classes, and being a seller in the secondary market is generally not rewarding, because it means you need liquidity and people can extract a discount from you. With regard to all the other items on this page, you're in compliance, but that one item is something that we manage through the cash flow process.
All right, thank you.
Thank you.
okay, so going on to item 9, discussion and action approving a resolution adopting the proposed budget for fiscal year 2025 through 2026.
Mr. Sanchez?
All right, good morning. So I have for you a condensed version of what we saw last month. Very condensed, it's just this one slide, essentially. I do have backup slides if you guys want more information, but largely the budget remains unchanged from last month. As we did mention, we were estimating a 2.5% increase for the CPI going for the salaries. It came in at 2.7. So the difference from last month's proposed budget to what you're seeing now is $2,076 in the salary and benefits. Everything else remains unchanged from what we showed last month. For the COLA, that would be effective September 1st, if approved. That is the
That's
board's choice.
Staff COLA, I just want to make sure anyone that's listening
Yes.
understands that's a staff COLA.
Yes, that's for the staff, and that's a board decision whether or not that's granted. It's all or nothing. And then everything else remains unchanged. I did send out updates to everybody for the questions that were asked during last month's meeting. Didn't receive any additional requests for information. So at this point, we're looking at a request to adopt the FY26 budget for $101,365,234.
Before we get a motion for that, are there comments, questions from the board?
Just for the odd participant who's watching, who hasn't watched any of the previous few meetings, can you just quickly explain what explains the jump from last year?
Okay, yeah. So this year is definitely an oddball. We're taking a different approach as to what we budget, not adding any additional expenditures. They're all things that were part of our expenses in years past. We had just not included them in the budget. So a huge portion of this $8.6 million increase is because we hadn't previously budgeted the $4.3 million in investment fees and some additional costs there in the operations. Actually, I can go to the backup, and so these are additional operating expenses that had not traditionally been included in our operational budget that we're choosing to now include in our annual budget. So again, not new expenditures, just a new way of showing things. And so this entails a huge portion of that increase. The other part would be just the retirement benefits that increase about 4% each year. So that other $3.5 million, that's just a natural increase.
And then on the operations side, those are things that the board was approving month to month that are now rolled
Correct.
into the budget.
Yeah. So previously we were taking those as part of your agenda as the expenses came up. Now we're just putting it into the annual budget. So again, nothing changed. It's just a matter of difference on how we're showing them.
All right, thank you. Yeah, important for
Yeah, great question.
someone who's tuning in only today and picking up on what looks like a significant increase.
Right. Good point.
Adrian, can you just clarify, there is a COLA of what percent and then a other increase as well to salaries? 'Cause I know
So
that's a question.
the way that we do our salary increases for staff, and this is all part of our policies, our personnel rules. So we have merit increases that's based on each individual's performance. And for this year's budget, I'm estimating a 3.5% increase to salaries, because that's traditionally what we've been giving out. Again, that's dependent on people's performance. The second portion is a CPI increase. That's our COLA, for staff COLA, and that's based on the July CPI for any given fiscal year, and so any given calendar year. This year the CPI is 2.7%. This one is the CPI is up to the board to whether or not that's given. It's all or nothing, and it's based on that CPI. So those are the two aspects of a staff's increase in a given fiscal year.
Okay. Any other questions, comments?
Just one question, more for curiosity. That CPI, July CPI, all or nothing decision by the board? That's our policy.
That is the
officially?
policy,
Okay.
yes. And a few years ago, we put a cap on that at 5%. But so if it ever was a case that the CPI was higher than 5%, the max is 5 now. But CPI has, or this is based on inflation, right? And so this is just to give back the purchasing power so this isn't necessarily a raise. This is just to give the equivalent purchasing power to the staff based on the CPI. And you're correct, that's based on, our policy is that it's up to the board to give this. So we can't choose to give 1%. It's
There's
all or nothing.
nothing fractional. It's either we give the
Right.
COLA,
Correct.
staff COLA.
Right, and these are identified
internally or
in
not.
your personnel rules and regulations, so they've already been identified. The guesswork on merit increases for their yearly evaluations is all outlined in your personnel rules. And then this COLA which the board is never not given. It's certainly up to the board. If you choose not to do that, then we won't include it in the budget, and that's kind of how it works.
Yeah, and I'm not suggesting that we shouldn't do that. I just, still a newbie moment, my first
Yeah.
budget, so, thank you.
And just to clarify, we, a couple years ago, we did adjust the pay brackets for staff, correct? And
So we actually
so-
adjudged, I'm sorry.
yeah.
I didn't mean to cut you off.
Two-part question. Remind us on adjusting the brackets, and then the bracket does cap what you get regardless of what the COLA would be approved, correct?
Right, so right now, we don't have anybody that's at the top end of their wage bracket. What we do with the wage brackets is that we actually go by the ECI, and this was part of the class and compensation study. So we go back and confirm that ECI as of June with CBIZ, who's the one that did the class and compensation study. They tell us what the ECI is for June of that year, and we adjust the wage brackets every year based on that ECI. And so right now, we have, everybody's within range, nobody's out of range. If there has been instances in the past where somebody has been at the max of their wage bracket, and so they weren't given the merit part of their increase because they were already at the max. But since we had the class and compensation study, that adjusted things, and as of now, everybody's within the bracket for their
But
particular.
ultimately, the bracket controls
Correct.
the maximum they would get in a year.
Right,
Sure,
and the
Ash.
authority for us to move based on the ECI is identified in the PUN's personnel rules and regulations, so.
Just a reminder, it's a small organization. We want to make sure that we are not losing staff and we don't have turnover. This is one thing that makes us more attractive. Folks that work here do not have civil service protection. And we want to make sure that we are attractive and are retaining employees. The board, coming out of strategic planning, suggested to staff or directed you all to do a class comp study. Found out some things there, but the class comp study looked at other pension funds to see how we're paying. We had to make some folks get caught up because they were behind
That's great.
what equitable salaries are in other locations. And so, yeah, just some more history on that.
We also had an organizational review
Yeah,
performed
true.
that basically reviewed the current organization, the staffing that we had, and for the most part found it appropriate.
Right, the number of positions, the
yes.
level of positions, supervisory ratios, all of that was done as well. It's a good
Right,
point.
and as a reminder, the staff here is not city employees, so the stuff that the city does get, every 5 years they get and I'm not sure when that stops, but 5, 10, 15, they get
Longevity bonus.
a longevity bump.
Increase.
That does not come to our employees, we don't get that. Anything with the minimum wage increases that the city's been doing, we don't do that here. So these two aspects of the salary increases is what the staff gets here.
So you do receive an annual COLA, and then there's a possibility of your employees receiving a merit every year?
Yes.
That's the difference?
That's the two aspects for salary increases for an employee.
And then, did I misunderstand, or did I hear correctly? So the wage bracket is modified annually?
Yes.
Okay.
Yeah.
So it could potentially be moving, I'm assuming increasing, so that it captures
Yeah,
everything.
so it is increasing based on the ECI for each year. But again, we don't move people's salaries because of the wage bracket, we move them because of these two aspects on the budget.
Thank you.
Any other comments, questions, before we have a motion to approve the budget? Okay.
So I move to approve the budget resolution, adopting the budget and related matters for fiscal year FY 25 through 26.
Second.
So we have a motion made by Mr. Rumkus, seconded by Ms. Hamblin. All in favor?
Aye.
Aye.
Hi.
I hope you-
Any opposed? Motion carries.
Thank you.
So going on to item 10. Going on to item 10, discussion and action regarding issuing a request for proposals for audit services.
Mr. Ash?
Robert Ash, Executive Director. Each year, we're required by law to perform an annual audit. And CRI has been performing the audit, Carr, Riggs, and Ingram, since 2019. We've kind of extended them 3 times. The FOC met on August 8th and reviewed the audit needs and what's happened over the last few audits, and is making a recommendation that we go back out for a request for proposals. We have not terminated at this point CRI. The RFP is in your backup, the draft RFP. The thing that we need to make sure that we're all in agreement of at this point is that the evaluation factors will be 50% based on price, including a 2-year extension. So the term would be 3 years with a 2-year extension possibility. And the other 50% is experience in auditing other public pension plans and qualifications of the audit staff. Again, this is something that's required by law. We are aware that the city is anxious to get this going and completed. Last year, they were stressed out because we were kind of towards the end of the audit period for them to get their audit done. So they were pushing our auditors as much as we were pushing our auditors to get it done. We know that we're kind of later in the year with August being the end of our fiscal year. So we intend to fast track this so that if you were to approve this, then we would hit the street today with this RFP with responses back around September 10th. It'll take us kind of a week to accumulate those and then have an FOC meeting soon thereafter, and interviews to follow with hopefully an audit firm in place by October is what we're kind of looking at. So that in a nutshell is kind of what's at stake here. You don't have to agree to this. We do have a contract with CRI and we can continue with them, but this was a recommendation coming from the FOC. And Matt, I don't know if you have any comments.
Yeah, we met earlier this month to discuss it, and really I think it had just become clear over the past 2 audits really that CRI just was unable to dedicate the resources necessary to perform the audit capably and within the time frame we've needed. The delivery date had always been right up to the wire. It had there had been some staffing turnover with the audit team, and they never really replaced or adjusted. And so we just felt that it was time to go out and see what the other offerings were. I know there's probably some concern about the time frame. We discussed a lot with Robert, because he's the one that him and his team are every year executing the audit or executing our side of the audit with the auditors. He felt that we would be in good shape. We're still in the current fiscal year, so an audit wouldn't be started until late October, November anyway. So we do have some time to get everything in place, but it is something that does need to be fast tracked, as Mr. Ash said.
And just CRI who would be able to respond to this request for proposal also.
Closer.
CRI would also be able to respond to this proposal too, so it's not like we're canning them at this point. We're just going out for proposals.
Correct.
So yeah, we put it on our website as well so that anyone can respond to it that feels that they're qualified, and we'll mail it out to some audit firms as well.
Do you see selection by the board in September or October?
So the proposals won't be back until like the 10th. We'll open them on the 11th. Staff will kind of accumulate the responses. I think that it's too early to have a recommendation back, especially if the committee wants to interview audit firms. So I'm anticipating October.
Okay, I'm concerned about making sure that we meet the city's timelines. In fact, that's one of the reasons that we're looking at this, because of the tardiness of CRI, but that's my major concern, is bringing somebody on and getting them up to speed super fast. So I asked the FOC to be thoughtful in who they select, and that timeline is very important to Margarita, Robert Cortinas, and the city, and so we want to make sure that we're not holding them up on issuing their audit.
Got a quick question. So CRI had pretty favorable pricing last time around. I think that's why we chose to stay with them after the current term. So we anticipate a little bit higher cost this go round. Did we anticipate that in the budget we just adopted?
I would say no, but to me, this is when we bring forward that contract, we authorize them to increase the budget to factor in this contract. So if it's higher, correct me if I'm wrong, we could stay with Carr, Riggs, and Ingram. We have them under contract. So if for some reason we don't get quality proposals, or we don't move quick enough to get somebody online, we can keep with Carr, Riggs.
We have not terminated Carr, Riggs, and Ingram at this point.
But my thought is, if we do select another firm, that's part of the action item, that we authorize staff to increase the budget for the new contract. Or if it comes in under, then we can decrease the budget at the same time as well.
Correct.
So I guess one last question, what is our target date then to meet the audit demands of the city? When would we like to see a contract awarded?
So October would be ideal. Remember, our fiscal year ends August 31st. Our custodial bank doesn't finalize our accounting statements, that kind of used as a trial balance by our auditors for another 6 weeks after that. So they wouldn't even be able to start until mid-October. The issue, I think, is, as Mr. Studer indicated, can we get that contract done in time for the October meeting? I don't anticipate that we'd have a lot of problems with that. And then with the auditors, whether it's CRI or another firm, be able to get the audit done by December, including the ACFR, and I'm sure that the committee will delve into that to see who's capable of doing that and who's not.
Maybe the question I should have asked is, when does the city need or expect our audit completed?
So there was a new law passed this last legislative session that the city made us aware of, where they have 180 days to complete their audit work. Otherwise, they could be fined or sanctioned somehow. That's our deadline as well under state statute. So I think our goal should be, rather than having everything completed in February or January, to try to move that up a month if that's possible. So again, that's coordination with the audit firm, whoever does it.
Could be wrong. I think they always had 180 days, but now there's stiffer penalties.
Right, I think they've identified penalties now.
Yeah.
And the same thing is with our plan. We've had 180 days under state law to get our audits completed and filed with State Pension Review Board. We've never not met that deadline, but last year we were working on the ACFR into February. So.
And while we have 180 days, we don't really, because we need to give it to the cities and their audit firm so they have time to incorporate it. So by law, we have 180 days, but we don't, because we're a component unit of the city, so we really have to.
Right, so we're kind of squeezed. By the time we get our statements from our custodial bank, you're looking at mid-October, and we push them every year. And then you're kind of looking, hopefully get everything done by December. So it's got to be an audit firm that can respond to those timeframes and act accordingly.
Representative Fierro, you had a comment?
Thank you, Chair. Mr. Ash, is it not, I guess we could discuss this in October when we meet and talk about strategic plans. But isn't it best practices to have an RFP every 3, 4, 5 years for this type of service, just to have fresh eyes, to make sure nothing's being overlooked?
So there's no state mandatory legal obligation as far as the time period to have an audit contract reviewed, as far as sending out RFPs. Typically in the pension world, we kind of have longer terms. So Callan's been on for an extended period of time. Our custodial bank, even though we'll go out periodically and look at what other custodial banks might offer, sometimes through our investment consultant, we don't change those a whole lot. I think 6 to 10 years is probably the time frame to get a fresh set of eyes looking at things, and that's what we did with prior audit firms. And so the last time we extended this, which was only in 2024, just a year ago, we were taking that as the last extension that we would anticipate anyway. So yeah, I mean, they've had time, let's put it that way.
Representative Fear, I once had a wise CPA consulting firm explain to me that as long as they're changing the audit partner, then that is usually part of the best practice. Yes, that's that fresh eyes from a higher level. And so you don't have to do a 3, 4, 5 years, but there is a time frame of which, okay, we're going to get new folks from the same firm involved.
Thank you.
So I have one question.
Please.
I understand that current firm can be part of the process, but we would be looking at them to see if the things that bothered us now are gonna be found, they're good now. I mean, we wouldn't be just giving it to them because their price or whatever. We're gonna see if their personnel is back in place now, if they have more personnel, if they're gonna be able to meet deadlines, and they're gonna have to show a little bit more due diligence, I think, to us.
I
for
think,
them to-
I'm
For
sorry.
us to, for us to look at them again.
Will they
Going
be
forward.
evaluated
Yes.
against other firms based on the terms specified in the RFP? And so, I mean, they're gonna have to, you know, obviously,
have to show
50% is price, but 50% is, are you bringing the resources that we need to
Right.
complete
Okay.
the audit? And so if they're gonna be considered, they're gonna have to be competitive.
Right.
Yeah, I would say they're being
Okay.
judged the same way the other firms
Yeah.
are,
Okay, but-
and it'll be a new proposal from them. And
Right.
so, I wouldn't say we're asking them to remedy anything, they're gonna get judged just like everybody
Yes.
else.
Okay.
And to pick up on what Matt said, I think there was a market, we really noticed when the local manager stepped away. The pricing was very favorable, so we did stay with them, but the impact from losing that local competent manager, we didn't realize, I guess, her importance till she left. And so this last cycle, I think, has highlighted that, so,
Okay.
it was kind of a notable event.
Okay, thank you.
Quick question. What is, just for the sake of understanding our contingency option, what is the length of term that we have remaining with CRI?
So we just extended for 3 years, so we can use this year and 2 future years
Okay.
with CRI. Like I said, we have not terminated them at this point, so they're still under contract.
In 20.
Okay, and I would imagine we're able to terminate for convenience?
So yes, we have in our contract, we have a 30-day termination for convenience provision.
Okay, thank you.
Okay, well, I have a motion to issue, I move to issue an RFP for audit services as recommended by the Financial Oversight Committee.
Second.
So we have a motion made by Carl, seconded by Representative Canales. All in favor?
Aye.
Any opposed? Motion carries. Going on to item 11, discussion and action on a report from the Executive Director, Robert Ash.
Robert Ash, Executive Director. First of all, many thanks to Adrian and our staff in working on the budget this year, as well as the Executive Committee. Certainly something different this year for all of you in reviewing it with your questions and taking a deep dive, especially with the change in methodology. Something that I don't look forward to every year, but now that it's done, we've got some marching orders, so thank you. There was a special session held, and it looks like there's going to be another special session held at the state legislature. One of the bills that was proposed in the special session was Senate Bill 12. It didn't make it out of the House in the first special session, but that bill would prohibit municipalities and counties in Texas from spending public money for a lobbyist. And since this didn't pass, we don't have an immediate issue, but it may be refiled in the second special session. We do receive some public monies, and so this may impact us as far as being able to keep SGT as lobbyists going forward. They're aware of it. They have kind of thought about and are thinking about possibly offering an amendment to exclude public pension plans from the bill. I don't know if that'll get any traction or if they recommend it. They didn't like the bill, the way that it was drafted. There was some ambiguities in the bill, the way it was kind of drafted in the first special session. Don't know if those will be remedied in the second special session, and it's hypothetical. It hasn't been filed yet, They haven't even started the second special session, but I just wanted you to be aware of that. That may impact us in our ability to employ a lobbyist going forward. We'll keep you posted. The strategic planning session be held on October 29th. The executive committee met with some staff members of the city's performance office who will be leading that meeting. And you can expect that they'll be in contact with you in the near future. Remember, every year we've sent board surveys to you and asked you to complete those. Please anticipate that at some point before the strategic planning meeting, the performance office may reach out to you from the city and ask you some questions. And that'll take the spot of our annual board survey. If you'll just be frank and upfront with them, I think it'll probably be 5 or 6 questions that they'll ask you. They'll document it and move forward. So they're coming up with those questions now. And I just ask that you answer their questions when they contact you, because your responses will be used to help define what's going to be at that strategic planning meeting. I think they're a good group, and they've had practice in doing this, and so I think it'll be beneficial for our meeting.
The idea is that we might be able to get to a better starting point by asking more probing questions, or allowing more color than just a survey would, where you're kind of like, oh, let me quickly get through the survey and check yes or no, or rate it on a whatever. Instead, we'll have them being able to probe and ask follow-up questions so we can get a little bit more in depth as we start our strategic planning process.
So just don't put them on ignore like this is a prank phone call or something. I just wanted you to be aware of it. The Techspur Summer Forum was held at the beginning of August 4th and 5th, and I want to thank all of the 5 board members that attended and the 3 staff members that attended. It was well attended. About 320 people attended from across the state, and people from outside the state attended. The mayor opened the forum with some really nice comments, and really more extensive comments than I've ever heard a mayor provide for an opening statement at a conference. So that was nice that he was there. Again, over 300 people attended. We've asked them to come back in the future. And I sent a thank you message to the Techspur's executive director, Art Alfaro, thanking him and telling them we'd like to have them back in El Paso. For those that attended, there was a form that you could have filled out for the hours that you attended the conference, so that you could meet your MET compliance, your mandatory education training requirements for the year. Every year you've got to have 2 years, and if you get that form, either through an email from Techspurs or some type of verification, if you'll send that to David Garcia in our office so we can document internally as well, then that would be very helpful to us. So to the extent you get some type of form from them or email saying that you received so many hours of MET, forward that to Mr. Garcia in our office, and that would be helpful.
Mr. Ash, did Art disclose attendance last forum versus this one? Do we know?
He said there was about 20 people more with this than 2 years ago. So we had about 305, I believe, 2 years ago, and we had like 327 attend this year's forum in El Paso. So numbers were good. I didn't really like meeting at the Civic Center. We were in a huge room, and it made it look like not many people were there. But when the second day they moved it back to the hotel, and in their conference facilities, it looked like there was a lot more people. So I think we had a smaller room at the Civic Center. It would have been better, but we weren't in charge of that. And for whatever reason, that's kind of how they set it up. So hopefully that was my feedback as well to them, is maybe a smaller meeting room might be better for optics. But other than that, I think it was well attended. The speakers were less investment oriented, I think, this time than 2 years ago. 2 years ago, I think it was probably 80% all investments. This time it was probably 50%, and different types of investments you typically wouldn't hear about.
Mr. Ash, we thank you for representing our entity well by your participation on the panel. You did an excellent job.
Thank you very much.
You weren't the most colorful person on the panel.
No.
You certainly were the most.
No one's ever called me the most colorful person in my life. So.
And if you were there, you would know I said that he was on a very diverse panel. So.
We also made a presentation to the city's FOAC, Financial Oversight Committee. Adrian actually presented to the FOAC last month, and his presentation was based on the presentation we provided to the mayor and the city manager. He was able to answer questions posed by the members of the FOAC, and not a lot of questions. They kind of jumped around in the agenda for whatever reason. They did fire and police pension first. They were there. They jumped around to some other items, and then they came back to us. But certainly, I think the underfunded liability was important to them. But again, nothing major that you need to be concerned about as far as their questions. I think it was well received. I wouldn't be surprised if we have to do that again next year maybe, or the following year, but it was well received and Adrian did a good job. And with that, that's the conclusion of my report, unless you have questions.
All right, thank you.
Thank you.
So item 12 is for notation only and brings us to the open comment period. We have no one signed up for that, and we don't have any items for executive session. Brings us to adjournment.
Motion to adjourn?
So we have a motion made by Caro, seconded by Representative, Mr. Fierro, Representative Fierro. All in favor?
Aye.
Any opposed? Motion carries. The meeting is adjourned as of 9:46 a.m. Thank you.
I like reading it, I'm like, it's not on.